In the previous video, I showed you how to compute the stock price based on the future dividends and selling price, using the future dividends and selling price. The models that we used were not something new. You had seen them before. But now I want to show you a new model, which is called Gordon Growth Model. Gordon Growth Model is very similar to previous models that I showed you, but there is an assumption here. The assumption is the dividend will grow at a constant growth rate forever. So let me draw the timeline. This is today, T1, T2, T3, and going forever. So this is D1, next year dividend or next dividend. This is D2, the dividend that will be paid at the end of year 2, the dividend that will be paid at the end of year 3, and so on. And here we have D0. What is D0? D0 means already paid, just paid, the dividend that already paid, and it won't be included in the price because what happened in the past based on this model won't impact the price, won't be included in the price. So we always look at the future where we want to use the dividend model. So we look at the future dividends, discount them to the present time, and this is the price of the stock. And here the dividends, the future dividends are D1, D2, D3, and so on. And the assumption is going forever. So the main assumption here is the dividend is growing at a constant growth rate forever. So the assumption is dividend will grow at a constant growth rate that I name it G forever. So the dividend must grow forever. If the dividend is growing just for 4 years, we won't use this formula. If the dividend is growing for 10 years, we won't use this formula. So the dividend must grow at a constant, for example, at 3% forever. It's going forever, right? Then you can use this model. And the formula to compute the stock price is next dividend divided by R minus G. Price is next dividend. D1 means next dividend, right? R is interest rate and G is the constant growth rate. And D1, next dividend is D0, 1 plus G, because we assume that the dividend is growing at G% forever. So D2 is D1 plus G% of D1. D3 is D2 plus G% of D2. So it's growing at G% constant growth rate forever. So of course, if you are interested to compute D2, D2 is D1 multiplied by 1 plus G. Or you can replace now this D1 with this D1. So it's D0, 1 plus G power 2, right? And then you can compute D3 as well. D3 is D2, 1 plus G. Now I replace D2 with this. So I get D0, 1 plus G power 3. Do you see any pattern? Yes. So D N is, or let's try D, Dn equals D0, 1 plus G, and power is, okay, this is 3, this is 3, this is 2, power is 2, 1, power is 1. So N, this is N, right? Why I'm interested in Dn? Because you can generalize the formula. You can change the formula to P. You can write the general form of the formula at P n means price in year n, price in year 2, price in year 10, price in year 15. Always is next dividend divided by R minus G. So price at any point of time is next dividend divided by interest rate minus growth rate. And you can compute this dn plus 1. dn plus 1 is d0, 1 plus g, n plus 1, right? So if you want to change, I can plus 1, right? So I can compute this. So if you want to compute price in year 10, it's D11 divided by R minus G. But now let's use an example. Assume that next dividend, so be careful about this. I mean, when you read the question, see whether you have been given D0 or D1. Sometimes we give you D0. D0 means just paid dividend. So if you saw in the question is just paid means already paid. So it's D0. But in the formula, you need D1. So you need to compute D1 based on this formula. Sometimes we tell you is next dividend. If it's next dividend and you want to compute price today, it's already given to D1. So D1 means next dividend. D0 means just paid dividend. Now, let me give you an example. Assume that D1 next dividend is $1. Then R is 10%. Then G is 20%. Now what will be the price? So the assumption, I'm just giving you an example. Suppose that next dividend is $1, R is 10%, and G is 20%. Now, what is the price? Let's compute the price based on you and assume that it's growing at a constant growth rate forever. Now, what will be the price? Price is D1 divided by R minus G, means 1 divided by 0.1 minus 0.2. So it's 1 over minus 0.1. This means minus $10. So what does it mean? Minus 10, the price is negative. This means you can buy the stock and the seller will also give you $10. Is it possible? No. So there is something wrong with the formula, right? The issue is, the assumption for the formula is R must be greater than G. In this example, R was less than G. So the formula cannot be used so we can use when R is greater than G, and it must be greater than enough. For example, if R and G are very close, for example, is 10% and this is 9.999%, so these are too close. So in the denominator will be a very small number, maybe 0.0001. Then when you divide D1 by this small number, you will get maybe 1 million ringgit, right? 100,000 ringgit. So it can't be used. So the assumption is R must be greater than G, and it must be greater than enough. But what if R was less than G? It's not in the scope of this subject, but I tell you what to do if you are interested to know more. If R is less than G, means the growth rate of the company is very high, right? So in this case, the company is growing very fast, and then what happens? Other companies will find that this company is doing very well and is growing very fast, making a lot of money, so they will enter into the market. So the competition will increase. And what happens? Because the competition will increase, so the growth rate of the firm will go down, right? Then the growth rate will go down, and until it's reached to stable level, right? And usually it's less than the interest rate or required rate of return. So when R is less than G, we assume that this high growth rate won't be forever. So we just assume after a few years, the growth rate of the company will drop and it will go below the required rate of return, or R, and then we will apply this formula. So for the first few years, for the first year, maybe for the first few years that the growth rate is higher than required rate of return, we just discount the cash flows one by one, and then after a few years, when the growth rate dropped to something below, went below R, then we will apply the formula. But as I said, it's not in the scope of this subject. So in this course, we assume that R is greater than G and is greater than enough. So this is the way you can compute the stock price based on the assumption that the dividend will grow at a constant growth rate forever. And let me show you something interesting before I finish this video. Assume G is 0. G is 0 means there is no growth. When there is no growth means all these are the same. So if there is no growth rate, there is no G, so the formula will be D over R. And this is the perpetuity formula, because perpetuity formula assumes that it's the same D forever, and if there is no G, actually it's the same thing, the same D forever. So it will become the perpetuity formula if there is no growth rate. Okay, so this is the Gordon growth model. So later I will show you some examples, and we will apply the formula to answer some questions.